welcome back to another episode of Global Insights with me, Punita Kumar Sinha. In the last episode, we discussed the outlook for China. Today, we look at the Indian economy, whose global significance has risen over the last few years. With global investors increasingly focusing on India and China amongst key emerging markets, it becomes even more relevant then to understand how India can evolve as an economy and market of global prominence in the coming years. The three questions we are asking today is: what is the potential of the Indian equity market? How will a deeper bond market help India's position globally? And when will India graduate from becoming a key emerging market to becoming an important global market? Joining us to throw more perspective on these questions are two very special guests. Rajeev Bhaman, Director Global Equities, Oppenheimer Funds, joins us from New York. And Luke Spajic, Manager of Asian Credit Portfolios from PIMCO, joins us from Singapore. Gentlemen, thank you very much for joining us today. Rajeev, I want to ask you a very open-ended question. And my first question to you is, what are the three things which come to your mind when you think of India?
Reform, a change from the previous orientation from statism to a more pluralistic dynamic, and an economy that hopefully will benefit from a meaningful decline in commodity prices.
And Luke, the same question to you. What are the three things that come to your mind when you think of India?
Three things that come to mind when I think of India. I think the first one is clearly opportunity. There is a large-scale growth opportunity across India. There is a very diverse economic system in place with lots of different sectors that are viable. And there is an incredible demographic opportunity where 60% of the population is under the age of 30. So the first general idea that springs to mind is opportunity. The second one, dare I say it, is probably frustration. A little bit of frustration with the speed of the reform process, a little bit of frustration with the access that foreign investors can have to the debt market. And I think that frustration really sums up in really unlocking the true potential. There's certainly frustration. And I think the third thing that springs to mind is probably a more personal one. It's cricket. I think there's an enormous obsession and passion for cricket. And coming from England, I really appreciate that. I think they're the three things. So there's opportunity, frustration, and cricket.
Yes, I guess cricket, everybody's a big fan. So let's talk about the opportunity part then. How do you map the opportunity in the debt markets in India?
I think that there are probably three or four things that make us feel like the opportunity is a substantive one. I mean, the first one is that it is a large-scale debt market. Probably the local debt market is probably north of US $1 trillion. The second thing I would mention, though, is that it is limited in terms of foreign access. It's quite hard to get hold of paper, and actually as a foreign investor there are lots of quirks in terms of participating. The third thing to note is that there is a reluctance to open up the local debt market for lots of reasons, but at least from a foreign investor standpoint, we'd like to see more of those limitations reduced. And the final point is that it is attractive. The valuations are attractive, the carry is attractive, and the policy framework around the bond market and the things that we see relative to other countries in the zone makes India look attractive.
Rajeev, your colleague Justin, who runs the Emerging Market Fund, has said that India is at a transformational phase. Do you agree with that?
Yes, I agree in as much as it has the potential to be at this transformational point. I think it is at a transformational point. Execution is critical to achieve that.
So what do you think it would take for India to actually transform?
I think it takes a sustained commitment to change, a willingness to change that goes beyond rhetoric. I think historically we've had plenty of opportunity to change, but it's never been sustained because the dynamics of pluralism require compromise, sometimes extraordinary compromise, in a fashion that derails even the best intentions. And I think there seems to be an opportunity, maybe an opportunity that is more significant than has been seen in the last 30 years, to actually make these changes happen, given the size of the mandate that Mr. Modi has received. And I think there's an opportunity to actually organize the system better, to make it more open, to make it more dynamic, to make the changes last by removing obstacles which have always been in place. Red tapeism that is just extraordinary, I think, compared to any large economy. And I think that's going to make the change. It won't happen in a year, but it'll happen over a long period of time if we establish the principles on which the economy should be based.
Luke, how does the India credit market look to you versus other emerging market credit markets?
I think that the first thing to say about the Indian credit market is that it's had an extraordinarily good run from, let's say, the first half of last year. There was a lot of value in the first half of last year, and a lot of that value has come in the credit market. We think that as it stands right now, the credit market looks reasonably fairly priced. Some things may stand out, like a handful of auto names may stand out, maybe the odd bank, but on the credit side, the market is really fairly priced. And having said that, there have been moves in other Asian markets, notably in China and some of the other credit markets like Malaysia and Indonesia, that have cheapened up a little bit to make them look a little bit cheaper relative to India. But our general view is quite optimistic about the development of the corporate credit market in India.
Luke, but from the view of foreign investor participation, how do you see India compared to other markets?
Well, we split the debt market in two. There's a local debt market and a foreign currency denominated debt market. The local debt market, as I said, is quite difficult to access. The local debt market doesn't really belong to any global emerging market indices, so every investment is off index, which means that investors have to use up their units of risk in something that isn't within their investment framework typically. So it gets harder to invest in India per se on the local side. And even on the sovereign side, there is no sovereign bond, which means that you need to have, I would urge India to issue a foreign bond, we'll come to that, but there is, relative to the other countries in the zone, they tend to have larger credit markets, they tend to be more liquid, and tends to be more diversity in the things you can invest in. So when I look at the Chinese credit market, which has evolved enormously over the last 3 years, there's an abundance of credits, there's an abundance of corporate opportunities, and again, it's a scaling issue. That's why the other credit markets look a bit cheaper right now, and they offer much more diversity.
Rajeev, emerging market portfolio managers have to include Indian companies in their portfolio, but what would it take for global equity managers to put Indian companies in their portfolio?
Unfortunately, a lot of that has to do with the tyranny of the indices. A lot of people don't make decisions outside of their index benchmarks. So that sometimes doesn't happen. Obviously, people tend to take off-benchmark decisions when they perceive the opportunities to be extraordinary. A lot of that tends to be driven by macroeconomic features. What we've had in India in the last year is not really any economic growth from the perspective of corporate earnings. So in an environment where there's a worry about interest rates rising, particularly in the United States, and the knock-on effect that has on emerging markets, it will not be typically when people make decisions to invest in emerging markets, including India. And people tend not to make the distinguishing, they don't distinguish between one sort of emerging market and another sort of emerging market. They usually bucket all of these things together. I think people are getting more sophisticated, but I think we have a lot of room to go. People are enthusiastic about India. I think everyone sees the possibilities. A billion people doing much more in 10 years, offers a lot of opportunity, of course. And so people will see that opportunity. We can see it with the big brand name companies in India that trade very expensively compared to most parts of the world. So it's not like they're unaware.
And Luke, what do you think it would take for global bond investors to invest in India in a meaningful manner?
There's a very simple 3-point plan that policymakers should follow. The first one is, and this is a very, very strong view that we have, is they should issue sovereign bonds, look to tap the 5-year and the 10-year sovereign bond market. This will give a very solid marker for valuations, for all valuations. Any kind of issuance that comes from India will have a very, very solid marker. The second thing is opening up the local bond market to more foreign participation, opening up the access so that investors can be much more broadly invested. And joining those two things together, the third point is to join the indices and effectively join the index family, get included in local, in sovereign indices, which means once you do that, it allows foreign investors to benchmark themselves and have much more long-term dedicated capital in India. They're the three simple points to make.
Rajeev, as we've seen, the Indian earnings have not been that good, barring a few sectors, some of the ones that you have also mentioned. Historically, we've seen Indian companies growing up to 20% or so. Do you think that we'll go back to those growth rates?
I have no doubt they can go back to historical levels of 20%. Obviously, the economy needs to grow faster. I think once policy, stasis is resolved, I think once the government is seen as actually having done things rather than talk about things, and once companies start acting on that, I think obviously it probably takes the government-directed investment first before people, before the economy gets the lubricant. And I think when that happens, people will jump on that bandwagon. And once, confidence returns and people can see their way forward to faster growth, everyone will jump on that bandwagon. We're strong believers in optimism. I think once the optimism returns to the corporate sector, I think earnings can definitely grow at 20%.
Luke, how do you see that compared to China?
Well, the Chinese growth rate was driven by a very particular model. The model was investment-led, with a currency that was very stable. And there was a lot of capital and a lot of debt raised to make that investment process work. Now, China is tilting towards a more domestic demand-driven economy and is going through a lot of structural change to make that happen, whilst keeping its currency very stable. And we kind of know where China is competitive and what they've done well over the last decade. And there obviously are pockets of internal investment, like the housing market, that have been a concern for a couple of years now, but has probably found a bottom and is beginning to reshape itself. For India, I think India needs to really figure out what the model should be. Is India's model going to be another low-cost investment-led export model, or is it and something like the Made in India program, which whether that's going to be really focused on domestic demand, or is it going to be focused on export demand? And I think this is what we're trying to figure out as well. We really need to see where the model is going to be going over the next few years.
Rajeev, and the same question to you. Why do you have more investment in India vis-a-vis China?
Well, I think China is much more opaque, at least for me. I think the quality of financial reporting in China is less good. We have investments in China, but we find that the value-added investments in China tend to be in companies that are non-Chinese companies that actually provide a service or a product in China, with the exception, of course, of the internet companies, which have to be domestic. But many of the other companies, particularly the listed ones, tend to be large, directed by the government, or opaque, or where we can't find the right price. So it's a variety of reasons why. I think India offers slightly better opportunity in terms of returns to our way of investing. We have, a variety of companies that we always have on our radar screen. The big problem is not so much finding companies that are great companies. The real problem is finding them at the right prices.
But we certainly look to sectors where there could be value add, things like technology, things like autos, and perhaps, when the commodity cycle does stabilize and finds a bottom or a level, then maybe even the commodity sector may start getting interesting again.
Rajeev, as you say, you like good managements at good prices, but these are very hard to find now because markets are very efficient. So how do you spot these themes, and where do you see the opportunities today?
So we're very much focused on companies. We're always focused on companies. We believe in the microeconomics first. The macroeconomics offer the opportunity set, but we don't make decisions based on short-term macro or monetary policy decisions. We look for enduring businesses that have the opportunity to consistently earn above their cost of capital over long periods of time. So we have, a variety of companies that we always have on our radar screen. The big problem is not so much finding companies that are great companies. The real problem is finding them at the right prices. So typically, the right prices are offered only in crises, or when people forget that the underlying growth rate of the business is higher than the growth rate demonstrated at present. So we're looking for those opportunities everywhere. I think Indian banks offer that opportunity, specifically in India. I think infrastructure companies almost everywhere in the world, given interest rates the way they are, will see faster growth, because there is no way that most democracies can afford to neglect infrastructure and the delivery of value to their populace. We think that those companies will be allowed to earn a return as well, because it's so important to grow those economies. So we think that's where the opportunities are. I'd prefer not to talk about the specifics of what we're doing right now, just because it's against our regulations. But I can talk about companies that we own that we think are well positioned, in various parts of the world.
So you don't think that Indian private sector banks are expensive?
Well, they're expensive relative to other banks in the world, yes, but expensive relative to the opportunities provided over the next 10 years? No, I don't think so.
And Luke, where are you seeing the opportunity today in the debt markets? Where are you investing?
Okay, so we think we're looking at industrials. We're looking at autos in particular. We're trying to find those markets where there is going to be a cost advantage in particular. And like I said, we were very interested in banks 18 to 24 months ago, but a lot of those have repriced a lot and don't really offer that much value. But we certainly look to sectors where there could be value add. Things like technology, things like autos, and perhaps when the commodity cycle does stabilize and finds a bottom or a level, then maybe even the commodity sector may start getting interesting again.
And what is making you buy autos given the slowdown that we're seeing there?
Well, I think it's valuations. At the end of the day, valuations will drive our risk appetite, and a deteriorating economic backdrop isn't necessarily a bad thing for the credit story. Maybe a bad thing for the economic story, but as long as the credit metrics look reasonable and there's no major deterioration in that set of data, then we're going to be fine owning stuff that actually ends up a little bit cheaper or looks cheaper on a relative value basis.
And why do you like industrials? Because they're already quite leveraged.
Well, there are a couple of things there. First of all, I mean, we know that the industrial side of the equation is very much linked to the banks. There are lots of loans that need to get rolled over. There's lots of sticky debt at the banks that needs to be unlocked. But one of the most important things that we're looking at right now is that the investment cycle in India hasn't really started. It needs to be unlocked. And that really comes from the government in terms of spending money on roads, rail, and really speeding up the investment process. Once that happens, then you'll see more liquidity coming back to the economy, and perhaps an improvement in bank balance sheets, and some of the loans that have become a little bit sticky can improve. So on the back of all of that, we're on the lookout for companies that want to borrow in foreign currency. And we're quietly optimistic that over the next 2 or 3 years, there will be a lot more issuance in Indian space, a lot of companies that want to borrow in dollars or in euros, and we'll be looking at those companies more actively.
Final questions to both of you. Rajeev, coming back to you first. Is this the time to be investing more in India, given where we are? I mean, the US rate cycle and the volatility that we're going to see arising from that potentially?
So we're long-term investors. So I think the first important thing to understand is our typical investment horizon is 3 to 5 years. So for us, is this the right time to be investing in India? Yes, because we like to invest when other people are less interested, because our time horizon is a little bit longer. We believe that investing today will offer us very good returns over the next 5 years. And so we're likely to be increasing rather than decreasing our weighting in India.
So Luke, is it fair to say that you're overweight Indian government bonds, but underweight Indian corporate credit?
We're overweight Indian local government bonds relative to other local government bond markets.
So Luke, you expect the quality of Indian corporate credit to improve from here on, right?
From here, yes, but subject to all of the things we laid out on things like structural reform, on things like the external imbalances staying where they are, growth being sustainable, and also inflation being largely in check, and that we start to see an improvement in the local banking system. Again, we've got some very strong views in terms of how much capital needs to get raised and what banks need to do. But clearly one of those things that will help is foreign access and new capital coming into the economy.
Well, thank you very much to both of you for joining us today. Joining me now is Tanveer Gill, and she's going to highlight India's position in some global portfolios. Tanveer, what are you seeing in global portfolios?
Well, as you discussed with your guest, Punita, it seems like right now, India's position in global portfolios is very limited. It's very scarce. But when you look at the portfolios of the likes of Fidelity, PIMCO, Oppenheimer Funds, they are stepping up on their India exposure, both in their equity as well as bond funds. So as far as emerging market exposure is concerned, India is well invested. It's really, India breaking into global portfolios, both bond and equity, which would be game-changing for India's perception. So I think that holds the key. And that brings me to my question for you, Punita. So for somebody who's been looking at the Indian market and emerging markets for more than 25 years and has been investing in that space, how have you seen India's profile evolve? And where does that take India from here?
You're right, Tanveer. I mean, starting in the early 90s, no one really knew India. And it was not even on the map of any global investors. And now, of course, people are taking a look at it and even investing. Of course, in emerging market portfolios, India has played a prominent role. But in global portfolios, it is now again being looked at. And I think one of the potential attractions of India to global investors has always been that Indian companies are very well managed for the most part. And they really like the way the companies are managed and the growth that they offer. But of course, that growth is somewhat cyclical in nature because India's economy is a bit cyclical in nature, and we've seen ups and downs over the last few years. I think this time around, there is a lot more hope and optimism that the government will deliver, and therefore more investors are looking at India right now than they have in the past.
But my only follow-up to that question, Punita, is how much time do you think would it take for India to reach the kind of prominence, global prominence, that China enjoys right now?
Well, China enjoys prominence because it's larger economy than India. I mean, it's in the top 3 or 4 economies, and India is still to get there. That's one. The second thing is what happens in Chinese economy affects the global markets a lot more than what happens in Indian economy. For instance, what we're seeing in commodities, as China slows down, all the commodity prices are impacted. On certain cases, I think Indian companies rate better than Chinese companies. Indian companies margins are better, their return ratios are better, they have better managements, and I think therefore even if the economy isn't making the headlines, Indian companies can. And I think one area in particular that Indian companies in the past have made headlines and have brought India to the global stage has been the IT services sector. Now that's lost its sheen. So I think we need to see more and more sectors or innovation come from India that could again bring India onto the global stage, even if it doesn't have the buying power that China has.
So India's on track?
Well, I definitely would hope so. I think there's a lot of optimism and hope. Well, that's all from our end on this edition of Global Insights with me, Punita Kumar Sinha. We return next week to discuss the new reality of commodity prices from oil to gold to base metals. Will this continue? We ask an expert panel next week. See you then.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.